8 months ago, I released a video titled Lower Risk Safety ETFs with 5% plus dividend yield. It focused both on the Canadian and American stock market, and it got 27,000 views. So obviously there's some interest in safer funds, right? So I also did a recent YouTube survey where I want to see what topic you guys want me to cover next. And this topic, safety ETFs, once again won, right? So it really wasn't a surprise to me because in 2022, we're having a bit of a rough start to the year, a little bit more volatility in the stock market compared to last year. And if you're a newer investor, I'm sure you're getting some jitters, right? This is completely normal, don't worry. And trust me, it goes away with time and experience, especially if you are an income focused investor, a buy and hold investor like myself. But I really do believe that getting the highest possible yield, the highest possible total return should be a secondary priority for do-it-yourself retail investors like us. The first priority, in my opinion, which not many people talk about or ever discuss, is really mental health, right? What's the point if you're going to be stressed, if you're going to be anxious, if you can't sleep at night? What's the point of doing anything at all if that's what's going on in your life? That's just how I feel anyway. So in today's video, I will present to you what I think are safer, more stable, and less volatile ETFs that you could invest in to help bring some stability to your portfolio long term and some serenity in your life as well, especially if you're a do-it-yourself investor. So I will focus on US listed funds or funds on the American stock market in this video because last Sunday's video, which was the same thing but focused on the Canadian stock market. Now, keep in mind, everyone, just a disclaimer here, it's very important that just because I consider these funds safer or more stable, which essentially means they will fluctuate less than the overall stock market, they can still fluctuate. I just want to make that clear. If the market goes down, they will go down also, but typically not as hard, right? So don't think that these funds will never move in terms of stock price or act like money in a cash savings account. That's not what this is at all. They're simply more conservative options for income-oriented investors where you want to get at least some higher yield, some high 5-6% yield with less volatility, less fluctuation. So the criteria for all today's picks is at least 5% yield minimum. So there are many safety options out there with yields of less than 5%. But in my opinion, if you're not getting at least 5% on your money, I'm not interested. I don't want to know about it. So it's important that you do your own research, make your own decision on one, if you actually need these funds, and two, which one you like best. And for the record, I do not own any of the funds that I'm covering in this video because for me personally, I feel like they're not necessary, but that's just me. If you want to add some more stability to your portfolio because it makes you sleep better, then listen up because I will cover 3 categories in this video, so you will be spoiled for choice. So the first category I want to cover with you, everyone, are risk-managed ETFs. I mean, this is a very popular or starting to become more popular in the US. You guys are spoiled for choice. I'm very jealous, but you have some awesome options when it comes to ETFs that use options, but instead of just covered calls, they used risk mitigating strategies basically to make it even more safe. So typically in the US, these strategies are referred to options overlay strategy. So my top choice would definitely be XRMI. So XRMI is an S&P 500, the S&P 500 risk managed income ETF from Global X. So you know how Global X basically has QYLD, RYLD, XYLD. XYLD is just the S&P 500 covered call ETF. So it's literally the S&P 500 with covered calls. So it's basically more defensive, a little bit more safer than just owning the S&P 500. Well, XRMI takes that defense a step further. So it's basically XYLD, so it does covered calls, and it does the same thing, right? You see here, XRMI seeks to generate an alternative source of income by selling covered calls, but it has a little hedge in here, and that's where the risk managed comes in, right? So the difference between XRMI and XYLD is that XRMI buys protective put options to mitigate the risks of a major market sell-off. So it sells covered calls, but it also buys protective put options, which protects the fund. It makes it even less volatile, or makes it more stable in case there is a broad market sell-off. So for that trade-off, the yield is probably going to be a little bit lower than owning XYLD, but that's the point, right? Whenever you're getting something safer, you're always going to sacrifice some return or some yield. So this ETF is actually very, very new. It's only been around, let's see, well, it's not that new. It's been around for about 8-9 months here. And you could see that the distributions are fairly consistent. I mean, it's not going to be the same thing every month, right? 20 cents, 15 cents, 23, 18, 19, 19, 25, 25, 19. So fairly consistent. So you could still get some really, really great yield of about 9-10%, believe it or not. And this is really, yeah, by the way, the put options are 5% out of the money. So if the market crashes more than 5% within a given month, you're protected. So think of it like a little extra insurance on the S&P 500. So S&P 500 is already fairly safe because it's 500 of the biggest companies in the US. Getting XYLD, which is S&P 500 with covered calls, is even safer. It's even more defensive. And XRMI takes it a step further, right? So this would probably be one of my top choices. S&P 500, I can't think of anything better to do this on because it's already safe. And there's other similar options out there that also kind of do the same thing. One that I found is a closed-end fund. So XRMI is an ETF, only 0.6 management fee. Same thing like XYLD, which is very, very low. But you also have closed-end funds that probably have a little bit more management fee, but these are typically leveraged. So I found one from Eaton Vance called the Risk Managed, see that Risk Managed again, Diversified Equity Income Fund. So the stock symbol is ETJ. And if we open up the fact sheet, you'll see that they pretty much do something very, very similar on the S&P 500, right? So they purchase out of the money, put options, and sells out of the money, call options. So it's pretty much the same thing, except the only difference I could see is that the covered calls here are out of the money, whereas the global X ones typically sell the covered calls at the money. But basically, it's the same kind of concept, right? They're trying to give you exposure to the S&P 500 in the safest way possible. And let's just check out the graphs charts, and I want to show you how the price is fairly stable. So this is XRMI, which is this one here, the first one that I showed you guys. And it hasn't been around that long, but you'll see that now's the perfect time to actually see what it does when the market starts becoming volatile and selling off. So this is typically at about 26.50, and you could see now in the past year it dropped to 23.70. So to go to 26 to 23.70, only an 11% drop. It's much better than the overall stock market, right? Not only that, but remember that it's not just about the stock price. It's also because you're still getting that income every month. So this is like a plan B. You're getting paid no matter what happens, right? So stock price relatively stable, and like I said, it's not just gonna not fluctuate at all. It's still gonna follow with the overall stock market, but to a much lesser degree. Same kind of story with ETJ. You'll see that it's relatively stable. This is the last 5 years. It's really, these funds are really designed to buy and hold for no volatility, or much less. So I correct myself, much less volatility. So very, very boring stock price. You see here it went up to 11. And then now it's back to 9. So these things in terms of stock price really don't move much. And keep in mind that you still get your monthly distributions. And I believe that both ETJ and XRMI, the yield is about 9 or 10%, which is absolutely incredible to get lower risk. But obviously, you're not going to expect much growth here. That is not the point of these ETFs. And another thing I just wanted to show you guys is that they also have the same thing for the QYLD. So QYLD is the NASDAQ 100 covered call. You could compare that to XYLD, which is the S&P. So they also have a NASDAQ 100 risk managed income ETF. So this is it's basically the same thing, except it's the NASDAQ index. So I would definitely go with the S&P 500 one if you're looking for safety and less volatility, because if you go with QRMI, it's more focused on NASDAQ companies, which is more growth, and tech companies, which is a little bit more volatile. So between the two, I mean, if you feel like you want to go with the NASDAQ one, that's completely fine. You'll get about the same yield, 9% yield or something like that. But when the Nasdaq is a little bit more volatile, and you could actually see that with the stock chart. So you've seen the last 6 months. This one here, I'm sorry, it's not this one. QRMI. This is the QRMI chart here. It still went down 15%. So although the Nasdaq went down really, really hard, this only went down 14%. So definitely less volatile, but the Nasdaq, don't forget, is going to be always more volatile than the S&P 500. And by the way, NUSI, which is a nationwide Nasdaq 100 risk managed income ETF, pretty much it does the same thing, right? It does the same. This is the same strategy. It's called the options overlay strategy. So QRMI is basically Global X's new competitor to try to compete with NUSI. NUSI's been around for a much longer time, and you can see, last 6 months minus 21%. Last 6 months on QRMI minus 14%. So it seems like QRMI is a little bit more stable than NUSI. Not sure why NUSI went down so hard in the last 6 months. Maybe their option strategies are different. But if you would ask me my top choice in this category, it would definitely be XRMI. It would be the S&P 500 risk managed ETF. So you could choose this one. There's also the ETJ from Eaton Vance, which kind of does the same thing. This one I think is leveraged though. There's a little bit of leverage usually in the Eaton Vance closed-end funds, but it's up to you to do your own research, check the management fees and choose one. But my top choice would be definitely XRMI in this category. Let's check out the second category now. Second category of ETFs and funds that I want to show you guys is defensive sector specific ETFs. So we all know that utilities, healthcare, these are two very, very defensive sectors, also called non-cyclical sectors, because they don't really have their cycles like financials with interest rates and energy with oil prices and gold with gold prices. These are relatively stable companies all the time because everyone needs their electricity, everyone needs infrastructure, telecommunication, and healthcare services, right? So this is why these sectors tend to be a little bit less volatile. So I'm giving you a couple of options here of what I feel are defensive sector specific ETFs that have relatively good yield. And Duff & Phelps has two of them. They have the Utilities and Infrastructure Fund, which the stock symbol is DPG. And basically they own, it's a utilities ETF, guys, right? So it's pretty much electricity companies, midstream companies, infrastructure, telecommunication companies. They have a nice diversification in terms of region all over the world. So this would probably be my top choice. It's been around for a really, really long time. If we look at the stock chart in the last, this is what, since 2011, so it's about 11 years that this fund has been around, and you could see the really nice stability. I mean, it started at 20, it went to 22, a little bit of fluctuation. You got the COVID hit here at 15 to 7 or 8, and then now it's back at 15. So fairly boring stock price, not perfect, right? Because it's still stocks, don't forget that. And this one here, I believe that the fund, actually I know it does, uses a bit of leverage. So there is a little bit more fluctuation because of that leverage, but you're getting a really nice 9% dividend yield on a very safe and more defensive sector. They have a more one without leverage. So DNP, this is the stock symbol. The DNP Select Income Fund gives you about 6.5% yield. So a little bit less yield, but has even more stability because I believe that they don't use leverage at all. And there's a lot more in the safer utility sector, which is electricity, gas, and water. So another really, really good option. If we look at the chart here, you could see it's actually very, very stable. This is since 1987. Wow, just like CLM. So do I see that right? Yeah, sorry, I thought it was 67. No, it is 87. So very, very old fund. Look at the stability of this stock price. It's absolutely incredible. Of course, keep in mind, it's not going to be perfect, right? You see the 2008 financial crisis here, 10 to 7 or 6 here, quickly recovered. And then you see the COVID, 12 to, where did it go to? 12 to about 9 or 10. So very, very stable, everyone, in terms of stock price. You're looking at about, well, it's actually right here. I'm not sure if this is correct, but it is about 6-7% yield, whereas DPG is a little bit higher at 9%. Yeah, so the yield should be right here. So really, really good utilities options, guys. Duff & Phelps. So it's up to you to choose which one you want you like best. Obviously DNP, lower yield, but more stability. And in terms of healthcare is also a very defensive sector. My number one choice would probably be the Tekla World Healthcare Fund. Stock symbol is THW. I looked at this. I can confirm that there is no covered calls on this, but there is a little bit of leverage, 17.85% leverage, which is very, very, very low and modest. So you're getting also a great yield of about 8-9% here. It's a fairly big fund as well. We're talking about, you know, almost 700 million. So it's very, very big fund. And it's basically all healthcare companies. It's all healthcare companies. So very, very, you know, conservative companies. You see the top 10 here, and you'll recognize most of them: Pfizer, Johnson & Johnson, AbbVie, Merck, Abbott, AstraZeneca, United Health Group. So it's basically what you want to see in terms of healthcare. It's mostly big cap. It's mostly United States, 70% United States, a little bit elsewhere in Europe. So another very, very good, cool fund that's, you know, defensive sector. And let's check. If we look at the stock price, you could see basically, again, very, very stable here since 2015. Very, very boring, very, very boring and stable stock price, which is what you want. This reminds me, it pretty much reminds me a lot of HHL, the Harvest Covered Call ETF on the Canadian side, which was a Canadian safety pick, by the way, last week's video. So it reminds me of that, except it doesn't seem like it uses covered calls. It only uses a little bit of leverage. So those are really the two main income enhancing strategies, conservative strategies you could use: covered calls or leverage, or you could even use both of them. So this one, no covered calls, but it has a little bit of leverage. So there you have it, guys. Some defensive sector funds that you could invest in. Keep in mind, it's still equity. The prices will still fluctuate, but the sector and the companies inside of them are much, much safer. They're more defensive because they're utilities, they're healthcare. So it's all services we need all the time, no matter what's going on in the economy. So let's check out the third category now. Third category is preferred share. So this would probably be, just like in my last week's video, like I said, my least preferred, no pun intended there, option. My favorite option would definitely be XRMI in today's video, but I'll give you some options for preferred shares here. Global X has 3 really good ETFs. I'm sure other providers have, there's a million preferred shares ETFs out there, but I think these 3 are really, really good to consider. So the first one is the US Preferred Share ETF. This is the biggest one. It has over 2 billion in assets. Very, 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 very low management fee. You're looking at a yield of about 6%. So these are legit preferred shares, guys, which means that it is still equity, but kind of like a hybrid between equity and debt, right? So it's a little bit safer than stocks or equity as a whole, but they still fluctuate. So PFFD. From Global X, US Preferred ETF. They also have one, I think this is a bit newer, PFFV, the variable rate preferred ETF. So I guess it's just variable rate. I don't know exactly what the difference is really between PFFV and PFFD, but I know it's preferred shares. This one's a bit smaller because it's newer. The management fee is a tad higher, and the yield is very, 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 very similar. And the third one that they do have is SPFF, the Super Income Preferred ETF. So this one has a little bit higher management fee. It's also a big fund at over $1 billion. The yield is a bit higher at 6.5, except the chart is not as good. So I'll show you that in a second. So this is the highest yielding option. It's really, they're trying to give you the 50 of the highest yielding preferred stock. So they're really trying to go after yield, a little bit more yield with SPFF, but you're going to pay a little bit more management fee for that. But if you look at the stock charts, this is the first one, PFFD. You'll see that it's actually pretty good. It's actually very stable. This has been around since, this is the last 5 years. So last 5 years we're looking at 25, and now it's at 22. So nothing crazy. PFFV, kind of the same story. Well, PFFV is newer. PFFV, sorry, is newer. It actually just came out 3 months after the COVID crash. So it started when the market was really in a crappy place. And you see that it recovered at 20. It went from 24.50 to about 28, and now it's back at about 24.69. So pretty similar to what PFFD does. And this one here has the most crappy chart. So in the last 5 years, it lost 16% of its value. So a little bit more volatility, but you do get a little bit more yield, but only 0.5 or not even that much. So honestly, my top choice would definitely be PFFD in this category, but all 3 are fine. You choose the one that's best for you. I just like this one because it's absolutely massive. The management fee is lowest, but the super income one, if you're okay with a little bit of volatility, this one is a little bit higher yield because they always try to go for the highest yield in this one. So there you have it, guys. 3 categories to choose from. Obviously, the first category would be my top choice, but you have plenty of options here to bring some stability in your portfolio if it's required. If it makes you sleep better at night, go for it, and you have plenty of options. So do your research, look at the stock charts, and whichever one you're comfortable with, or several, you could always get several, go for it. And if it makes you sleep better at night, I would strongly recommend them. Thanks for watching, everyone. Really appreciate it. Please show your appreciation by hitting that like button. It's free for you. It takes 2 seconds. It helps the channel grow. It helps get the message out. So it's a win-win. Also, if you like this type of content and you're not subscribed yet, make sure you subscribe. Hit that little bell button so you're notified of any upcoming videos. You don't want to miss them. And make sure to check out our website, passiveincomeinvesting.ca. That is where you could access a bunch of free tools and resources. You could download my portfolio, my monthly stock pick report card as well. And of course, that is where I offer my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once. It comes with lifetime updates. My plan is to do an update at least annually. So version 4 is scheduled to be released in Q3 of 2022. So stay tuned. It's going to be a really, really cool update. So this product is really to help you build your own portfolio no matter what your investing goals are. So it's not just tailored for income investors, but there's also sample portfolios, for example, for growth, for dividend growth, and income as well. So it's a really, really cool product. It's really designed to save you time on research, of all the all the crazy great funds there are out there. There's so many of them, so many ETFs out there. So this product will help you think of it kind of like a reference tool or reference guide to help you build your own portfolio. I also offer a one-on-one coaching session. It's right there on the homepage if ever you need more personal one-on-one touch, where you could ask me all the questions you want and I could assist you best I can. Keep in mind though, this is not a financial advice or financial planning session, because I am not a certified or a registered financial planner. This is just a regular lifestyle coaching session where you could ask me all the questions you want and I give you my opinion based on personal experience. Also, we have a Facebook page, over 11,000 members now. We are very, very strict about letting people in. We try to get rid of the scammers and bots right away. So it's a very, very cool group where everyone is sharing their experiences, asking questions. So make sure to join us there. Passive Income Investing is the Facebook group name. We're also on Instagram. We don't use it much, but we plan on putting more personalized stuff on Instagram. So make sure you follow us if you want a little bit more personal stuff on our everyday life. So once again, the mission of this channel, well, my mission will always be the same. It's to help ordinary, regular, working people invest on their own. Do-it-yourself investing in order to build your own stream of passive income, to enhance your quality of life and become financially independent, to become financially free. So as usual, stay safe, stay healthy, and of course, stay passive. See you next time.